Something strange is happening in the stock market right now. The biggest companies in the world, Microsoft, Amazon, Tesla, they're all down this year, some by double digits. But the market itself, it's flat. Some parts of it are quietly surging. Energy stocks are up 26%. Industrials up 14%. Small caps are beating the Nasdaq by the widest margin in decades. And while everyone's been staring at Nvidia earnings calls, the biggest shift in investing since the dot-com bust has been happening right under their noses. They're calling it the Great Rotation. Money is flowing out of the mega-cap tech stocks that dominated the last decade and into sectors that most people stopped paying attention to years ago. The question is this a head fake like the ones in 2016 and 2021, or the start of something much bigger? Let's look at the data. Here's the 2026 sector scoreboard so far. On the winning side, energy is crushing it at plus 26%. Consumer staples up 12%. Industrials up 14%. Utilities up 11%. These are the boring sectors, the ones nobody makes YouTube videos about. On the losing side, Microsoft is down 19%. Amazon down 13%. Tesla down 12%. The Magnificent Seven as a group are down about 5%. Nvidia's barely negative, but even a flat Nvidia is a losing trade when energy is up 26% in the same period. Now, here's why this matters, even if you don't own any of these stocks individually. If you own the S&P 500 through an index fund, SPY, VOO, whatever, 7 stocks make up a third of your entire portfolio. The Magnificent Seven are 33% of the index. That's up from just 12% in 2016. So, when the market returns 1% but the Mag 7 are down 5%, the other 493 stocks are actually doing much better than you think. The S&P 500 Equal Weight Index is up 5%. The version where every company gets the same allocation, it's crushing the regular S&P by 5 points. That's the single clearest signal that the market is broadening out, and money is following. Record $29 billion flowed into sector ETFs in January alone, the best start to any year ever. The Equal Weight S&P fund has pulled in $6.5 billion this year. Bank of America says institutions are now the most overweight small caps versus large caps since April 2021. Let's zoom into the small cap story because it might be the most important one. The Russell 2000, which tracks 2,000 smaller American companies, is up 5.3% this year. The Nasdaq 100 is down 1%. That's a 6-point gap in just 2 months. Small caps just put together a 14-session winning streak against the S&P 500, the longest since 1996, and the Russell 2000 had its strongest opening to a year in over a decade. But here's the insight that most people miss. The headline Russell 2000 PE ratio is 33 times. Which looks expensive. But the value subset of the Russell 2000 trades at just 11 times earnings. That's 26% below its 20-year average. The rotation isn't into all small caps. It's specifically into small cap value. And small cap value is genuinely cheap. Why are small caps winning now? 4 reasons. First, domestic revenue. Small caps earn most of their money in the U.S., which makes them less exposed to trade wars and tariff uncertainty. Second, rate cuts. The Fed has already cut rates to 3.5%. Small companies carry more floating rate debt, so lower rates directly improve their bottom line. Third, earnings growth. The Russell 2000 is expected to grow earnings 19% this year versus 12.5% for the S&P 500. Small caps are growing faster from a cheaper starting point. And fourth, the valuation gap. Small caps were trading at a 31% discount to large caps coming into 2026. That kind of gap has historically preceded multi-year outperformance. So, why is this happening now, and not last year or the year before? It's because 6 catalysts hit at the same time. Each one on its own might not be enough. But together, they created the conditions for a major shift. Let me walk through them. Catalyst 1, the SCOTUS tariff ruling. The Supreme Court struck down the IEEPA tariffs in a 6-3 decision. The effective tariff rate dropped from 17% to 9%. This removed a massive overhang from consumer and import-dependent sectors. If you watch my previous video, You know this story. The 150-day countdown is still ticking. Catalyst 2, rate cuts. The Fed cut rates 3 times in late 2025, and the market expects 2 more cuts this year. Lower rates favor small caps, value stocks, and rate-sensitive sectors like utilities and real estate. Every half-point cut expands small cap margins more than large cap. Catalyst 3, AI spending fatigue. The Mag 7 are expected to spend $700 billion on AI infrastructure this year. That's up 60% from 2025. But the market is starting to ask a simple question. Where's the return? Microsoft's $37 billion quarterly AI spend spooked investors. NVIDIA reported 73% revenue growth, and the stock still fell 5%. Capital is rotating from AI builders to AI adopters. Catalyst 4, earnings are broadening. For the first time since 2021, all 11 S&P 500 sectors are posting positive earnings growth. Industrials grew earnings 26% last quarter. The gap between the Mag 7 and the other 493 companies is closing fast. February's market breadth was the second best in 50 years. 65 to 69% of S&P 500 stocks beat the index. Now, here's the question everyone's asking. How long does this last? Let's look at history. After the dot-com bubble burst in 2000, value in small caps outperformed growth for 7 straight years. Small cap value returned positive 19% in 2000, while the Nasdaq fell 78%, and the outperformance lasted from 2000 all the way through 2006. The 2016 Trump trade, financials and industrials surged for about a week after the election, then underperformed for the remaining 3 years and 51 weeks of the term. The 2021 reopening trade lasted about 5 months. The Russell 2000 gained 50% versus the Nasdaq's 22%, but by summer 2021, the rotation reversed as the transitory inflation narrative took hold. So, which one does 2026 look like? I think the evidence points closer to the 2000 multi-year cycle than the short-lived 2016 or 2021 trades. Here's why. In 2016 and 2021, the rotation was driven by sentiment and expectations. In 2026, it's driven by actual earnings growth, broadening and structural policy changes. The SCOTUS ruling isn't a tweet, it's a Supreme Court precedent. Rate cuts are happening, not just expected. And the valuation gap between large growth and small value is at historical extremes. Morgan Stanley's chief strategist says he's the most bullish on small caps since March 2021. Goldman Sachs sees a broadening bull market. Bank of America is recommending increased small cap exposure. But here's the honest counterpoint. Goldman also says the Russell 2000 may not meaningfully outperform the S&P 500 over the full year. And Capital Economics warns this could be late cycle distribution, disguised as healthy rotation. The kind of pattern you see before bubbles burst, not after. So, what do you actually do with this information? Let me give you a practical framework. Step 1, check your real exposure. If you own the S&P 500 through an index fund, you already have a 33% allocation to 7 tech stocks. If you also own QQQ or individual tech names on top of that, you might be 50% or more in tech-adjacent sectors without realizing it. Log into your brokerage, look at the sector breakdown, and write down the number. Step 2, consider tactical tilts, not dramatic shifts. This is a rebalancing, not a fire sale. The Mag 7 are still expected to grow earnings 17 to 23% this year. They're not broken companies. A reasonable approach. Trim 5 to 10% from your megacap, tech overweight. Add 3 to 5% to value through something like VTV or the equal weight S&P. Add 2 to 5% to small cap value. And consider 2 to 3% in international markets. Here's the part nobody talks about. Dividends. When you rotate from growth to value, you're not just making a capital appreciation bet. You're collecting significantly more income. The energy sector yields 4.6%. Financials average 4.2%. Utilities, 4%. Compare that to QQQ at 0.46%. That's a 10x difference in yield. Moving $10,000 from QQQ to energy generates roughly $400 more in annual income. You get paid to wait while the rotation plays out. Step 3, know what to watch. There are 6 signals that will tell you if this rotation has legs or is about to reverse. Watch the earnings convergence between the Mag 7 and the other 493 stocks. If that gap keeps closing, the rotation continues. Watch credit spreads. If investment-grade spreads start widening, small caps will get hit first. Watch the Fed chair transition. Jerome Powell's term expires May 15th. A new chair could shift the entire rate trajectory. Watch AI CapEx returns. The next round of Mag 7 earnings calls will reveal whether that $700 billion in spending is generating real revenue. Watch the July 24th tariff deadline. If Section 122 tariffs expire, that's another catalyst for consumer and import stocks. And watch the equity risk premium. It's currently near 0, the lowest on record. Any normalization favors value over growth. The market is telling you something right now. It's telling you that concentration doesn't last forever, that earnings growth matters more than narratives, and that the boring sectors just got a lot less boring. Whether you act on this or not, at least now you know what's happening beneath the surface. If you found this useful, subscribe. I break down these market shifts so you can make better decisions with your money. See you in the next one.